Every April, millions of Americans overpay their taxes, not because they cheated, but because they didn't know what they were allowed to keep. Today we fix that. Welcome to Fiscal Fluency. Today we're breaking down how taxes actually work, the difference between a W-2 and a 1099, how tax brackets really function, and the deductions most beginners leave on the table. Quick reminder. I'm not a financial advisor, and this isn't financial advice. This is purely educational. Tax laws change, and your situation is unique, so always consult a qualified tax professional. With that said, let's get fluent. Here's the biggest myth in personal finance. If I get a raise and jump into a higher tax bracket, I'll take home less money. That is completely false, and it trips people up every single year. The U.S. uses a progressive tax system. That means different portions of your income are taxed at different rates, not your entire income at one rate. Here's how it works with 2025 numbers. The tax year you're filing right now. The first $11,925 of your taxable income is taxed at 10%. Income from there up to $48,475 is taxed at 12%. From $48,476 up to $103,350, it's 22%. And so on up through the brackets. So if you earn $50,000, you don't pay 22% on all of it. You pay 10% on the first chunk, 12% on the middle chunk, and 22% only on the last few thousand. Your effective tax rate, the percentage you actually pay, ends up much lower than your top bracket. A raise will never make you take home less money. What it will do is push the dollars above the threshold into the next bracket, and only those dollars get taxed at the higher rate. When you get paid, the IRS gets notified. The form that does that tells them, and you, a lot. A W-2 is what you receive if you're a traditional employee. Your employer withholds income taxes, Social Security, and Medicare from every paycheck automatically. By the time you file, most of what you owe has already been paid. A 1099 is what you get if you're a freelancer, contractor, gig worker, or self-employed. No taxes are withheld. You're paid the full amount, and it's on you to set money aside and pay quarterly estimated taxes throughout the year. Here's the part that catches people off guard. If you're a 1099 worker, you owe self-employment tax on top of income tax. That's 15.3% to cover Social Security and Medicare, the portion an employer would normally split with you. So if you made $60,000 on a 1099, set aside roughly 25 to 30% for taxes until you know your exact liability. You can receive both in the same year, a W-2 from a day job and a 1099 from side income. Both get reported on your return. A deduction reduces the amount of your income that gets taxed. The IRS gives you two ways to take them: the standard deduction or itemized deductions. You pick whichever is higher. For 2025, the standard deduction is $15,750 for single filers and $31,500 for married couples filing jointly. Most people take this. No receipts, no math, just a flat reduction off your taxable income. Itemizing means listing out eligible expenses, mortgage interest, state and local taxes, which were capped at $10,000 through 2024, but increased in 2025, charitable donations, and certain medical expenses. If your itemized total exceeds the standard deduction, you itemize. If not, you take the standard. For the majority of Americans, especially renters and early earners, the standard deduction wins by default. Don't overthink it. One deduction beginners often miss: contributions to a traditional IRA or 401k reduce your taxable income right now. That's money the IRS can't touch until retirement. We covered both of those in earlier videos. Links in the description. Tax brackets are progressive. A raise never hurts you. Your W-2 means taxes were withheld, a 1099 means you handle them yourself, and the standard deduction is your baseline. Only itemize if your eligible expenses exceed it. The biggest mistake beginners make isn't cheating on their taxes, it's not claiming what they're legally owed. If you want to keep more of what you earn, you're in the right place. Subscribe to Fiscal Fluency. We break down the financial concepts that actually move the needle. Next up, we're covering one of the most powerful and overlooked accounts in the entire tax code, the HSA, or Health Savings Account. It has a triple tax advantage that most people completely ignore. Stay fluent.